Hey guys, just wanted to drop a little video here talking a little bit about the overall look because, of course, early this week we had the big JPM collar disappear. So I did a video on that. I'm going to post the description down below if you want to know a little bit more about how that works. And it also ties into a couple other videos I've done about how dealers do this. I was a market maker, options market maker for 12 years. So these are the things that I had to deal with all the time, these sort of gamma levels and having to chase positions at times and having to deal with both negative gamma, positive gamma. One is a clamp on volatility, reduces volatility, and one tends to be an accelerant to volatility. So very different situations. Just a reminder, everyone, of the disclaimer. So that anything we talk about today is for educational, entertainment, and information purposes only. Do not do any of these trades without looking into this, doing some paper trading, and most certainly checking with a financial advisor for investment, legal, tax advice, etc., etc. Options have a risk of losing all your money and even more than you've put in if you start to mess up margin and things like that. So you need to know what you're doing here and keep that in mind, please. Thank you. And then we'll talk about a little bit of an oil idea, kind of an oil hedge that I put on yesterday. So right off the bat, here's the picture here. So if I can describe, the red parts are negative gamma and the green parts are positive gamma areas. So we can think of the market as being kind of right around that 5,700 level. So we've got a little bit of negative above, but mostly positive down to around 5,600. So without getting too into it, if you haven't watched the other videos, think of it as this. Positive gamma is going to act as a volatility reducer. It sort of puts a clamp on, and I've explained this before. It's for example, if there's a huge positive gamma here, dealers are going to be selling above, they're going to be buying below. Now, if they're months away, they're going to be selling ahead of that as well, because those have some value. So they're able to sell futures before it even gets there. On expiry, they basically need to buy any of those futures back that they were short, and that's what happened into the 5750 pin over the past week, or at least up until Tuesday. We have this 5750 pin until that position was rolled. So now the position's been rolled out to above 6,000, and we have, as I mentioned, we're sort of free to roam about the room. I said, be careful. Come Tuesday, this is going to be a different market. Now, of course, we don't know about Middle East problems necessarily flaring up at any given moment. We can't predict those things always, but we knew that there was going to be this sort of structure to the derivatives market that could actually clear the table for movement to happen again. And so oftentimes what we need is an accelerant to get, we need an impetus to get things going. And then if there's an accelerant, things can continue if there's a negative gamma situation. So hopefully this isn't getting too complicated, but let's just describe what we have now. Well, we have 5,700, we have positive gamma. We're seeing the markets having trouble selling off, even in the face of pretty bad news, right? This situation could escalate to alarming levels in the Middle East. This could get really ugly if one or both sides decide that, the gloves are off and we're gonna go hard. Up to now, and including last April, we had a situation where they were sort of telegraphing what they were going to do. They were basically calling the enemy up and saying, listen, we're going to be sending some missiles over there. And so everyone was prepared, and it was more of almost a kind of, heads up, no one's going to get too hurt, but we're doing something because our people require us to do something. So, it's a little bit of that softball lobbing situation. Are we going to get into a hardball type of game at this point? Could be. Right now we have positive gamma all the way down to 5,600. So what we're going to see is probably a lot of what we've been seeing this week, which is we get a sell-off, we get a rally. We get a sell-off, we get a rally. We have that support that partially comes from gamma. Now remember that this gamma world is one piece of the puzzle. So as I always say, it can be overwhelmed, right? If there's enough organic flow, if something big happens in the world, it may not matter that there's positive or negative gamma, but we have to consider that this world of derivatives and options is bigger than it ever has been by many multiples versus years ago. So this is having more of an effect. And so as day traders and as traders in general, and even as investors, we kind of want to know this stuff. So we have positive all the way down to 5,600. So we're going to have some support. We get below 5,600 and there could be a problem. We could get what's called an accelerant, an acceleration of volatility to the downside. So it's almost like the typical volatility clustering environment where things are going to stay fairly low, which they have been, even though the VIX is 20, the realized actual movement has been very low. So the VIX is starting to incorporate the election, what's going on in the Middle East, growth issues, labor issues, rate cut uncertainty, etc. All kinds of things happening now. The port situation. So the VIX is absorbing a lot of uncertainty, but it's not really translating into a ton of market movement. So right now we're seeing little sell-offs getting bought up, little sell-offs getting bought up over and over and over again. What is the reason? What ball will have to drop for us to get below 5,600? Well, we don't know. Maybe it's the Middle East escalating a little bit more. That could be the issue that pushes us to a level which we get this potential accelerant, and then a snowballing can happen here, as we've talked about CTA, vol targeting, risk parity. Some of these things don't kick in right away. They need volatility to start to rise more consistently, but that's going to start having an effect, and dealers are going to have to chase a little bit. Chasing isn't good. I can tell you, being on the positive side of gamma is a place to be. You get to sell on the way up, you get to buy on the way down. It's a fun environment, especially when things get more and more volatile, and you can pay for that theta over and above what you've got on the sheet. So it's a great environment. This is much less environment. You're chasing, you're selling into sell-offs. We've got synthetic selling as well from ETFs, ETPs, triple levered, double levered, inverse products. All these things are sort of synthetic short gamma that can play into this as well. So we have more of that than ever. All these products out there that people like to trade, the Soxels and things like that. So accelerant. So a little bit worried if we get below there. If we can get through, and to me it feels like the market just really wants to go up. It's sort of looking at 6,000 as a potential. Maybe we get another pin where the JPM collar has been rolled to, right? It was rolled from here over to here. And so now we have a new reality of this potentially becomes a magnet as we get closer. If the stars align and we get closer to these levels, of course, 6,000 being that big psychological level. I think if we get to 5,800 and above, we do have a little gamma supply there. So we don't have an accelerant, but we have this sort of magnetic, effect from the 6,000 level and then the JPM collar, upper collar. So I think the market wants to do this. But in the meantime, we certainly have to get over a few hurdles over the next few weeks. I think nobody can deny that. But at the same time, I don't think bears can deny that this market is incredibly resilient in the face of a lot of uncertainty and problems. So let's take a look at VIX as well. We've got negative gamma in VIX as well. So this is, remember what VIX has been doing. It's been really over it has a high beta to what the S&P is doing. I'm going to show you that right here. Let me grab another chart. Okay, here it is. So the VIX intraday beta to S&P. So what does that mean? It's sort of telling you, well, how reactive is VIX to S&P moves? And we know that as S&P goes down, typically the VIX goes up. There's an inverse correlation, right? As S&P goes up, VIX goes down, and vice versa. So we have, because it's the fear gauge, right? The people are rushing into buying protection and protecting their portfolios, and that pushes the cost of insurance up. So people, in fearful situations, the VIX goes up. So, but look at what's happening here. We're trading at 99th percentile in terms of how sensitive is the VIX to a move in the S&P. That is very interesting because there are times where the VIX is not as reactive. Certainly the VIX futures are not very reactive. In low vol environments, the VIX futures are really, the front future does not want to react unless there's a more serious sell-off in the S&P. But typically, you're going to get less of a reaction from the VIX unless you get into a fearful situation. So we know what happened in early August. We know what happened in early September. We know that the VIX just isn't giving it up right now for a variety of reasons. So it's sensitive, right? It's that cat in the room full of rocking chairs, right? That cat is nervous. And as you add more rocking chairs, which can be the Middle East, it can be the port situation, it can be the election, it can be, throw whatever you want in there. Each of those is a rocking chair, and the cat gets more and more nervous, right? So here we are with VIX being very, very nervous into this particular situation, sensitive. And I think for me, that makes some upside VIX protection look very interesting. Don't get into something like that unless you understand these products better. I'm just saying that the VIX is an interesting place. You're getting this big beta. Remember, the options trade based on the futures, not the VIX cash that you see on TV. But having said that, the torque is in the VIX product, and part of that is this sort of reality that we have here, that dealers, market makers, gamma players are negative, and they're having trouble. We talked about this in another video. They're having trouble with rallies in the VIX. It can turn ugly very quickly for some reason. Why? We're not entirely sure. Carry trades, everything's a carry trade, right? Everything's just a big house of cards, debt, this, short vol, et cetera, et cetera. I don't know. That's getting into a bigger conversation, but for some reason, or maybe after the GFC, risk budgets have changed. McGillicuddy was talking about that. Maybe risk budgets have changed, and we know that that's true too. The market makers aren't able to hold as much inventory. They're not able to take as much risk. They're kind of almost inert, saying, I can't be involved, and so. It's for whatever reason, liquidity is dried up in some sense when things get ugly, and here you go. So we can have an accelerant if VIX really wants to get going again, 21, 22, 23, we start get going again to the upside, and we have this accelerant. Remember, red is accelerant, green is calming. So, and then of course into the 30s, more accelerants, and this is partially how you get to a VIX 65 as we saw in early August. So, food for thought. It's kind of this new world that I've described many times on many shows and podcasts and things like that, that we're kind of in this, either or market, right? It's sort of vol clustering, either all heck is breaking loose or nothing's going on. And this is our reality. This is our reality. And it's a hard one because you're lulled into this sense that nothing's going to happen ever again. And then something goes, things go bananas. Has it always been that way? Well, of course, over history, it has been that way. But I feel that it's more, and we see it. We see it in the statistics. VIX comes back. VIX drops down faster than it ever has. Markets come back faster than they ever has. We're able to shrug things off more quickly than ever. So this is a new environment. This is an entirely new kind of environment driven by, incredible volumes of options and derivatives and on the realities of the equity side as well. So let's take a look at one idea. So we've talked about the XLE idea. Interesting. So in one of my recent videos, I talked about showed this video, and I said, there's some interesting areas. Oil and gas being very kind of unloved, very uncrowded. Not that expensive. We can see oil and gas not that expensive. Really great companies, super big moats, very high barriers to entry, right? Big invested capital, of course. I like companies with less equipment and things like that. Tech usually fits the bill, but there's no denying oil and gas, really great barriers to entry, and very great, what a great franchise they have, and massive cash cow companies. XOM, just one of my favorite companies, starting to break out now, right? So you want to take a look at the XOM chart, starting to really look good. Of course, part of that is our situation. So, as we start to layer these ideas, we come up with, okay, let's look at the chart, let's look at fundamentals, let's look at the story, let's look at, is it cheap? Is it underloved? Well, it's underloved. Look over here, energy, premium discount to fair value, right? versus technology, which actually isn't crazy, which I think is why, technology is still not a bad place to be, especially if we start not getting those rate cuts. And I'm starting to lean in that. I've been talking about that for a while. We may not, they're overdoing it on the rate cuts, right? Rates are predicting a recession. Rate cut plot is predicting recession. Stocks are predicting growth. I'm thinking stocks are right. And that's going to be, and things may heat up too much because rates are predicting recession. Rates are coming down. That's going to just juice things to the upside, maybe create some inflation. But that's another topic for another day. But right now, energy, not really loved, just like China. Remember China, when we last looked at this chart, China was like, left for dead. And what a rally it's had since on the backs of that stimulus. So what does this mean? Well, we're going to look at, we looked, it's under love. I don't mind something like that. Now, sometimes under love can mean that it'll be under love for a long time. So we need that spark, right? We need that accelerant if we start to think of the term that we use with gamma. What's the accelerant? Well, the Middle East situation is the accelerant. Today they're talking about bombing oil facilities. It's under love, unbelievably strong fund. So IV percentile 94%. So we've got this really, really high IV. Careful with rank. Rank can kind of sometimes be distorted by big spikes, which, for example, early August has now rendered IV rank a little less useful in my mind. What's more interesting is IV percentile. So I'm looking at IV percentile right now because it tells you how much of the time IV has been above or below the current level. And right now, below the current level. And so right here, 94% of the time, it's been below the current level. So you know that this is a high level of IV. Now, I don't love selling 90s IV, but given everything, I kind of like this setup. So what I did is I looked at the skew as well. So we've got this sort of relatively flat downside skew, which makes it interesting. We have high IV. Look, this is the 52-week level of implied volatility and the skew curve for XLE. And we can see that typically it's a little steeper. Not as steep now, is it? So interesting, we don't want to play the upside with a call spread because the IV is very, very high without or with a call on its own. Because it's very expensive, right? You're risking getting into something that's going to erode and potentially come back down in terms of option volatility. You're going to get that Vega exposure. You're going to get hurt. So you want to do it with a spread type thing. It's not low enough that I'd want to do a back spread like we did on my MSTR, made 550% or something like that. You can check out that video as well in my series on YouTube. But right now it's very high. Back spread, no bueno. So I went call spread. So I went 92. I went 92.97 call spread, and I sold an 88.83, right? So I'm selling this expensive put, and I'm buying a further down put in case things go wrong. And that's kind of pricing kind of nicely because we're sort of flatter here, right? Flatter tends to be okay for that. So we're taking advantage of this relatively flat skew here. This would be better if it was a little steeper, but look, it is flatter. On the call side, we call this flatter. It's on this side, this is, and this side is flatter compared to normal, which is downward sloping. So flatter is better for our call purchase, our call spread purchase. We're getting to sell that upper call higher as opposed to lower than here. So we have a couple things working for us. Selling the put spread, this looks good from the skew picture standpoint. Buying the call spread, this looks good from a skew standpoint. Nice trade. So remember, we're layering these things. Just as I went through that trade with MSTR, layer your edge. Where's your edge coming from? So we check all those boxes, and here's what the trade looks like. It's up some good money today. I think it's up, but I paid 29 cents for this, selling this put spread, buying this call spread. I paid 29 cents. It's up to 81 cents. So already doing really, really fantastic. I'm going to kind of watch and see how this plays out. I don't think the situation is over. So I don't see vol dropping. I don't see this fizzing out. But XLE is a bit of a heartbreaker, so I wouldn't be surprised. But I'm going to stick with this for a bit and see if I can squeeze a little bit more out of this trade. So if you want to know about any of my programs, I've got one starting next week on Tuesday. Got a bunch of students signed up. It's going to be fantastic. 5 weeks, live mentoring, all sorts of amazing stuff we're going to be doing. I'm going to teach you to do stuff like this, how to trade like a pro, and check out the testimonials. They're unbelievable over the last few months, and I'm just blessed to have such great, smart students, but willing to also say things about me and the program and how it blows them away compared to all the time they've wasted with other people, with other programs, with other so-called gurus out there. They're just absolutely thrilled. So look into that if you're interested. In the meantime, I'm going to keep putting out videos, and I hope you guys enjoy them, and we'll talk to you soon.